A lot of money is coming into the senior housing and care market, and obviously we've had a very busy M&A market the past year. I'm here with Adam Heavenrich, who is the founder and managing director of Heavenrich Company. And Adam, Heavenrich Company is, you're a bit of a jack of all trades. As a firm, where do you spend, most of your time? On the M&A side of things, the financing side, other financial consulting?
We're splitting our time fairly evenly right now between the M&A side, the investment brokerage side, as well as the funding of new construction. Over the next few years, we think that there's going to be a lot of activity in terms of new construction, new development, but we're also have traditionally and historically been known on the M&A side. So we're financial advisors.
And on the M&A side, what's the main reason why your seller clients are selling today?
Clients are, actually there was some motivation fairly recently in the skilled nursing sector in terms of the uncertainty of reimbursement that was causing some anxiety with the owners that motivated them to sell. But we've had a very good run since 2010 in terms of deal volume. As you know, it's been over $10 billion a year over the past few years, because you've got a terrific environment. You've got low interest rates, you've got low capital gains, and people have built up a lot of equity on the assisted living side, certainly, and just want to take a few chips off the table while the environment is so positive.
Mm-hmm. And are you more on the assisted living side, your clients, or the skilled nursing side?
Well, I was looking back, and generally we think of ourselves as evenly split. Over the last 9 months, we've done about $130 million of transactions, and about 2/3 of that was nursing. As I said, skilled nursing, I think simply because of the change in reimbursement.
Right. Okay. And then in your travels on the buyer side, is there one aspect of a target facility or portfolio that the buyers are really looking for that kind of convinces them to do the deal?
Right. Well, again, as you know, Steve, the majority of the transactions in this very strong market since 2010 have been run by the REITs, and they've been driving the transaction volume. And so the REITs have been looking at, they look for two things, yield and lease coverage. And so if the yield is there and they can have the coverage, you can make a transaction work. So by way of example, I think we secured about a $240,000 per bed for a skilled nursing company that was, somewhat older facilities, but they had the lease yield, and we structured it with adequate coverage so that everybody was comfortable.
240 a bed.
Yes.
Oh, I gotta go relook that one up. On the financing side of your business, can you describe a typical loan you've put together, and for what type of borrower?
Yeah, again, we're more advisors. We're financial advisors, capital advisors, and what we like to do is think that we, when we come into a client, that we provide integrity of judgment and in terms of analysis of their situation. So what we try to do is craft a solution that makes sense for what they need, and we're not just going to come with them and tell them that they need to sell a facility. So we try to develop a solution that meets their needs. So it's not, people aren't generally coming to us for debt. They'll come to Nick if they want to identify a single loan. If somebody comes to us and says, corporately we want to make a very large acquisition, we need to figure out the best way to approach that. How do we do that? We'll take a look at them and their cash flows within their corporate level, their the level of leverage that they have on a facility level, and an understanding of their growth plans going forward, and we'll craft a solution that best meets their needs.
All right. And the environment has changed and continues to change, but are you finding now that borrowers, there's kind of no pressing need, as opposed to 3 or 4 years ago, no pressing need to refinance now that the Fed has come out and said, well, we're going to keep interest rates close to 0 through 2015. So why rush to refinance?
Right. Well, again, I think that I don't think it's a refinance-driven market. I think that the good operators are seeing the next 5 years as a great opportunity to grow and to continue to grow. So they're thinking, and they should be thinking, how do we effectively meet the demand of our customers and grow our operations? And so how do we generate equity to do that? How do we generate the sufficient capital, and what will our capital structure look like in 5 years? So we're trying to help craft that, and there's plenty of demand for that.
Figure that out.
Yeah.
And then last summer you announced that you were exclusive advisors to a new $200 million fund, pretty much for any type of financing, or acquisitions in assisted living and the memory care side. Can you give us a little flavor about what you're looking for, what size, and what kind of transactions?
Sure. The fund is driven by development needs, so whether it's related to new construction or renovation, the core of the fund would like to keep transactions under the $15 million threshold, although we now have a solution that goes above the $15 million threshold. But the fund will provide the entire capital stack to what we're looking for is really good operators that have done a really good job and are looking to the next 5 years, as I had said, and saying, how do we most effectively and efficiently grow and build our company without splurging all our capital on one project. They want to diversify and but expand in the markets where it makes sense to expand.
Mm-hmm. And you will do for new construction, the fund will do 100% basically equity financing to get the property built up?
That's correct. We're looking, again, we will provide 100% of the financing, but we're looking for very strong operators, and the commitment that we're looking for from the operators is that they need to be diligent in terms of having known their market and where their new market needs are, and they need to commit to a lease.
Okay. Yeah, no, I would think you'd have a lot of demand for that, especially on the 100% financing on development as development starts kicking up. So right. You should have a lot of demand for those funds. Just got to find those good operators.
Yeah.
Now, 2012 sounds like was a pretty good year. What are the prospects for 2013?
Yeah, I think we're going to be very, very busy. I think we're already seeing our pipeline filling up for 2013, and I think it probably will be more weighted heavily towards the new development, new construction side. But there's still plenty of M&A activity, but the bulk of it is probably coming on the new development side.
Good. All right. Well, thanks for the update.
Thank you, Steve.
Good luck in 2013.
Okay.
All right.
Thank you.